Now, today I'll go through a few things. First of all, I'll give you just a very brief update on where we are in terms of the Chinese market internationalization, so we're all on the same page. Then I'll talk about the actual announcement from the SHFE, so essentially what came out on Tuesday, what the important significance is, and how this is going to impact the Chinese market, but also markets beyond China. I'll talk about basically, is this going to threaten the overseas markets, or is this something that can actually be beneficial for all markets? And then I'll go through a few more technical details. And ultimately, we have a Q&A session as well. Now, let's get started. First of all, right now, there are already different ways of accessing the Chinese market. There are 4 different ways that are commonly used. The first is essentially to set up a company in China that can directly trade everything, but it obviously has limitations. There's the risk of double taxation. It's obviously a fully Chinese company, so that means you have issues with fund repatriation. Then you have QFE, which is directed mostly at larger institutions. It is a bit more complex to operate and set up, and not necessarily straightforward. There are some issues around taxation as well still. So it is something that is available, but not perfect for all market participants, I would say. And then there are these 2 options on the right, the non-resident account and overseas intermediary options. They are quite similar. They offer the same access to the same products. But while for the NRA option, companies essentially need to establish a subsidiary in China, a bank account in China. With the overseas intermediary option, they can simply go through a broker outside of China. So just operationally, it is much simpler. There's no cross-border transfers they need to manage. Essentially, the OI takes care of everything in that regard. I'll skip through this brief history here. You can take a look at this in the slides later. But essentially, opening up has been going on for the last 7 years, since 2018, when the first contract was launched. And we've seen a sort of gradual expansion of the range of products that's become available, so that today we have around 24 products that are available under the specific product regimen. That's essentially the products you can see here. They are traded on 3 different exchanges, on the INE, on the Zhengzhou exchange, and on the Dalian exchange. And all of these products are, again, accessible through overseas brokers. They have both futures and options for many of these. And this is something that has been growing again for the last 7 years. So obviously, more and more products are being added to this range. Now, in terms of the SHFE internationalization, first of all, just a bit of background on the SHFE itself. The SHFE was founded in 1992. It is China's premier pricing center for metals, specifically base, precious, and steel. And it is also a pioneer of the opening up of the Chinese market in general. It started in 2018 when it set up the INE as its internationalized subsidiary. So that means essentially it's a separate company to have a so-called dual track or dual circulation opening up, where you would have the domestic market on the one hand, and then the international market on the other hand. The internationalized side would then be accessible to both international and domestic investors to essentially have a combined price. It would be VAT exclusive, so you would essentially have a bonded exchange with bonded contracts, trading sort of the China price without VAT, whereas the SHFE, for example, would then trade the VAT inclusive, fully domestic, post-tax, post-import price. So this is how the internationalization in China started. But this means that the SHFE still has a wide range of products that are not available yet to international investors, at least via the OI route. These include base metals, including all the basics, of course, but also aluminium oxide and aluminium alloy, which is going to be launched on the 10th of June. There's a few energy contracts, some obviously precious, as well as some industrial contracts, and also steel, specifically rebar, wire rod, hot rolled coils, and stainless. And so all of these are basically what the SHFE in general offers to domestic investors right now. And these are what investors can look forward to in the future then as well. Now, the Shanghai Futures Exchange itself features very strong liquidity and deep market. You can take a look at the screenshot on the right, which is just from earlier today. So they really trade hundreds of thousands of lots per day, not just on the big ones like copper and aluminium, but also on smaller ones like wood pulp, bitumen, and others. The reason for that is that the SHFE offers smaller contract sizes and thus attracts a wider range of participants. Especially smaller industrial companies, for example, can utilize, for example, a 5-ton copper contract a lot better than a 25-ton contract, which makes it just a bit more easier for them to hedge smaller quantities. Aside from that, there's also smaller individual punters. And then obviously in China, there's also at this point very large hedge funds, state-owned enterprises. And this entire mix of companies is very active on all of China's exchanges. So that's why you have this wide range of financial and industrial participants, all of which bring liquidity to that market. And initially, the dual circulation idea was that exchanges and regulators could basically separate the risk of inviting maybe more sophisticated market participants from overseas into the market and sort of give them their own playing field and essentially protecting especially the smaller domestic guys from that. And this way, for example, larger companies, hedge funds, they could, both Chinese and international ones could access the international market, and the domestic one would really just be for purely domestic hedging purposes. So, for example, if a Chinese plastics producer buys from a Chinese chemical plant, they could use the domestic Chinese plastics price for that. So that was the initial idea. And it worked out well for some contracts. The crude oil contract, for example, is very active. So is low sulfur fuel oil. But for the copper contract, this ran into a bit of an issue because obviously by setting up both a domestic and international contract, you split the volume. And SHFE already has liquidity, but the INE for every new contract needs to sort of prove itself. It needs to show that the market wants that contract and attract people to the market. And initially, when the copper contract on the INE was launched in parallel to the SHFE contract, which already existed, it started off okay. We saw, I think, around 10 to 20,000 lots per day. But the problem was that the dynamics driving the market changed significantly just a few years later in 2022, when, first of all, increasingly copper cathode imports were being replaced by concentrate as smelts were ramping up inside China. And also banks largely ended the very popular cash for copper trade, where essentially you could pledge copper as margin for very cheap financing. And so all of this meant that stocks in INE warehouses fell very rapidly. We can see that this is from about 3 years ago. We had stocks of around 75,000 tons. Right now, it's only around 10,000 tons. So the majority is obviously gone just because that trade has disappeared. And in addition to that, we can also see that the INE never really gained the same volume that the SHFE had. So right now it's hovering around a few thousand lots per day. I took these screenshots today, so this is, again, everything from today. We have a few thousand lots being traded and a few thousand lots of open interest. Whereas on the SHFE, it's literally 100 times larger. And so even in its best day, the INE never really managed to compete with the SHFE just on overall volume, but it has just overall declined in recent years just because the contract itself is not as attractive as it used to be. So the problem is, well, why is the SHFE internationalizing now? Well, right now, even Chinese companies can't actually use the SHFE when they're operating overseas. So, for example, with Chinese companies increasingly going abroad, actually their own overseas subsidiaries can't actually hedge products that they trade on the SHFE. So that means if a Chinese mining company, for example, sets up a subsidiary in Europe, in Africa, anywhere, and that company wants to export back to China, they can't actually access the Chinese SHFE contract. So this is one key driver. Another one is just that there has been very strong interest from overseas investors to get access to these contracts, just because trade with China is so important. And China obviously right now, I think, sees a bit of an opening for sort of establishing its own rules essentially in the global commodities market. Now, to actually really figure out what the announcement entails, I've got the sort of introduction of the announcement up here, and I'll go through a few key phrases just to really explain what is happening, what did they announce, and because again, there was obviously some reporting, but I think a few points may have been missed or maybe still unclear. So first of all, high-level opening up, construction of Shanghai as an international financial center, enhancing the influence of important commodity prices and promoting the high-quality development of the futures market. All of these are references to very established Chinese strategies, policies that have been around in some cases for several years, in some cases more recent. And so this is basically on the policy side, the exchange saying, okay, we are responding to all of these policies. And you can see that there is this existing range of policies that has been really promoted over the last few months to promote sort of overseas access and internationalization of the market. And so this is not something that has happened very suddenly. It's not because of the trade war or something like that. This is a very long-term process that has been going on for some time, and that is now sort of entering the next stage where we can actually see changes happening. In terms of the important points for all of us here, I would say there are 3 points. First of all is the phrase systematic internationalization of business rules. And here, again, they mention they will be opening up the whole process of participation in futures trading by overseas participants, revising and perfecting market access, trading, settlement, risk control, and delivery. And so here, the most important thing is that they are talking about the entire exchange. So this is not just nickel, like I think they indicated in recent months. This is really something that covers all of the SHFE. And again, this is emphasized by saying they want comprehensive participation in the domestic futures market. They want to comprehensively introduce overseas special participants, overseas intermediaries, and overseas clients to participate in the domestic futures market in the whole process. This is a bit stilted. It's translated from Chinese, so that's why the phrasing is perhaps a bit, inelegant. But I think the overall picture is clear. They are internationalizing everything. But, and I think this is a very important point, right now, all this is draft rules. These rules are open for feedback until June 4th. And then later on, probably in a couple of weeks, they will publish the final rules. But right now, this is technically just a draft. Most likely, it's not going to be all that different from the final rules. If you actually read the documents, there are 3 main goals they want to achieve. First of all is, again, the internationalization of the SHFE platform, introduce foreign participants. But in addition to that, they also want to support the internationalization of the renminbi and also implement foreign exchange as a margin and other systems, so specifically RMB internationalization and different currencies as initial margin. And in addition to that, they want to explore the regulatory system and business model, blah, blah. Specifically, they also want to provide reference and replicable experience for the internationalization of SHFE varieties in the future. What does this actually tell us? Well, it means that, again, as I mentioned, this is an overall rule proposal. There are many different rules that are being changed, delivery rules, margin liberalization, but this is just, again, the foundation of further opening up. This is not the final all-in opening up. So it's not like by the end of June, everybody will go and just trade all of those SHFE contracts. Instead, basically, these are probably the 3 most important questions here. Does the announcement mean everything will be open from June 4th? No. This is, as I said, the first step. This is a rule change to enable further internationalization down the line. Nickel is very likely going to be the first contract that will actually be launched, but it's going to be a step-by-step process. State media, when they reported about this, actually spoke about how this announcement is both historic, but also how it's very important to gradually implement this internationalization. So it's not going to be essentially one step and then everything is open. There will be further announcements down the line about which contracts will be opened up in what time frame. If you already have INE access through an existing OI, for example, will you get automatic SHFE access? Probably. We've been in close communication with the exchange. We are still working on setting this up. The key question is whether trading codes, i.e. trading identifiers for individual clients, can be transferred from the INE to the SHFE, since they are technically the same company. It's possible. It will certainly be quicker than if you don't have access. So if you have it, you will be among the first ones that should be able to trade this contract. And the third question is, delivery will be possible, physical delivery. On the INE, it's possible because the INE is a bonded contract, so it means everything is happening in a bonded zone. There's no VAT. On the SHFE, from launch, it's very, very unlikely, because the issue here is that the SHFE contracts are VAT inclusive. So that means the exchange needs to find a way to basically get foreign companies to issue VAT invoices in China, which is not something they would typically be able to do. So it's a more complex issue that needs to be solved together with the customs and tax authorities in China. So again, it's a gradual process, and essentially the entire Chinese market and SHFE access will evolve over time. So this is not a once and done thing. It's a first step. How does this actually impact overseas exchanges? Well, I saw some interesting takes online already in some reporting. But overall, I would say this is not a threat to overseas exchanges, because SHFE prices, as I mentioned, are VAT inclusive and reflect the domestic price for commodities in China. So this means, while China obviously plays a very important role in the global commodities market, these prices will serve as maybe Chinese or Asian reference prices, and especially when there is no international sort of competing contract, then certainly they will become benchmark prices even for international trading. But ultimately, the basics of commodities trading still apply here, and this means that grade and location matter. And at this point, no Chinese futures exchange has established any sort of global warehouse system that could compete with the LME. In fact, they don't even have any single overseas warehouse at this point. So that means all of these prices reflect the price of these commodities in China and not the sort of global overall price that, for example, the LME price would reflect. So this means it's not quite yet the beginning of the end for the LME. In fact, this is not the first time that a domestic exchange is internationalizing in China. So we can just look at an example from previous years to see how this is going to impact foreign exchanges and foreign markets. And taking INO as an example, as I mentioned, in 2018, the DCE opened up its iron ore contract. But at that time, the SGX already had an existing iron ore contract as well. So the question is, China, as the biggest consumer and importer of iron ore, if it opens its domestic market, is that going to kill the SGX? Well, as we can all tell, based on the fact that the SGX is still very much around today with its FE contract alive and kicking, no, the answer is very clearly no. Both volumes, both exchanges have seen growth in volumes and open interest overall. In fact, they have actually supported each other, because the SGX at the sort of multinational contract was able to get essentially more electronic volume from Chinese traders. On the Chinese side, you had maybe more liquidity as well, especially during the evening trading sessions. So it was actually something that benefited both exchanges, and overall, they're both still around. There's a very active arbitrage between those two contracts, and it has not destroyed liquidity on either exchange. And if we take, again, the SHFE, well, let's take a look at copper, for example, here. If we take a look at the CME and LME copper price dislocation that we've seen in recent times, the key point is that domestic, for a contract that is behind, especially a sort of VAT or tax wall, domestic trends matter, especially if it has only local or regional warehouses, and when the brands and warehouse locations are not in the same place as the same brands and warehouses of other exchanges. As traders realized, it's not that easy to actually get LME copper to the CME or the other way around, just because not all LME brands are CME registered and the other way around. There are tax issues. You need to actually ship it across the sea as well. And so this means there is a good reason why there is both a CME COMEX contract, rather, reflecting the domestic US price, and an LME copper price for the international market. And that same logic still applies in China as well. The SHFE is not going to just kill the LME, kill COMEX, copper, anything like that. It is going to be another reference price for copper, for example, in Asia, in China, and it is going to contribute to the overall market, not destroy it. In general, again, as I mentioned, there is a lot of potential for a very active but tighter, obviously, arbitrage trade, especially with the upcoming Hong Kong warehouses of the LME and potentially also the CME for its aluminum contract. There's also a chance to exploit price dislocations, especially for traders that have both physical and paper access. So, for example, if you see a backwardation in one market, you can maybe deliver into that. So there are going to be ways to make this very attractive to use both markets. There's going to be chances for RMB pricing for hedges, especially, which could be attractive, for example, to recyclers exporting material to China, and also anybody who's engaging in physical trade with Chinese companies, since this means as a foreign company trading with Chinese companies, you could, if you're exporting, offer to your clients in China a RMB price, which could be very attractive for them. And at the same time, the other way around, if you're, for example, using or if you're importing from China, you can, for example, use a domestic Chinese contract for pricing if there is no liquid international alternative. Ultimately, this is going to be a tool for both international and Chinese companies. As I mentioned, overseas subsidiaries of Chinese firms can't actually access their own market right now. And that is really why it's not just the SHFE, but also, again, the GFEX, Guangzhou Exchange, the Dalian Exchange, and the Zhengzhou Exchange, all opening up more contracts because they want to provide this access essentially to Chinese firms and international firms, and essentially establish China in the sort of global trading order. In terms of the actual operations, as I mentioned, there's a number of exchanges in China. All of them actually rank in the DCE, ZCE, and SHFE all rank in the top 10 by volume globally. And there is liquidity not just across things like copper and oil, but also in things like PTA, TSR20, and even peanuts. Right now, there are 24 futures and options that are available for international traders via the OI route. And all of these contracts, can be traded, again, directly from overseas. You can use, essentially, if you use an OI broker, you can have access to both the international and Chinese markets, all from the same account, which means you can use the same funds, move them across the border very efficiently. In fact, fund transfers in and out of China for us take less than 2 hours for our clients. And obviously, there's FX conversions and ways to hedge FX exposure, for example, using the SGX or HKEX, USD CNH contracts. The OI route is also tax-free in China, so that means any trading profits can be repatriated. There's no concerns there about taxation. USD can be used as initial margin as well. A variation margin is still going to be charged in RMB, but USD do work as initial margin. And the account opening process is significantly faster than, for example, using the QFII access route. It's also handled in English and with us, for example, subject to Hong Kong law, which I think for a lot of international companies might be easier than Chinese documentation, which they might struggle with in our experience at least. And lastly, as I mentioned, there's no need to open a bank account or a subsidiary or entity in China. It's all happening overseas. So it is very, very straightforward to set up. Essentially, you can trade China just like any other exchange. And I've got a bit of background just on how the regulatory system is structured in China. This chart is a bit scary, but I would say there's just a few things to point out. You have the trading code, which I'll be explaining on the next slide. And you have a very, very clear risk waterfall. There's multiple risk reserve funds, both at the exchange level, at the broker level, and at the overall market level. And supervision is very, very clear, both inside China, where it's all managed by the CSRC, and outside of China, where the OI broker is subject, obviously, to their local supervisor as well. And funds essentially are in the so-called closed margin loop, where the overseas trader can move funds through the OI into China, where they can then be used to trade futures, but they can't ever leave this loop. So that means the funds can only ever be used for futures trading or be just moved back out again. So they can't exit this loop and sort of disappear into China. The trading code is a very unique feature of the Chinese market. It's a unique client identifier. So that means every individual client trading in China, when they open an account, they get assigned this trading code by the exchange and regulator. And using this identifier, the regulator can basically track all of their funds, margins, positions, and trades across exchanges, brokers. It doesn't matter where the money is, basically, the regulator can see and can obviously make sure that the money stays where it should be staying. And this really enables the CFMSC to do something quite unique. And that is the CFMSC, which is the China Futures Market Monitoring Center, actually does its own settlement for every single client in the entire Chinese market. So with your trading code, you can actually get a statement from the Chinese regulator telling you where your money is, where your positions are, and at the same time, the other way around, the Chinese exchanges and regulators also have a pretty solid overview of basically what risk is like in the market. The trading code, in some sense, is the first line of defense because it's very clear if there's large positions, the exchanges and regulators can see that, so that if there are concerns around sudden price movements, they can act very quickly and see who might be at risk. But again, it's just the first line of defense. There's also percentage-based initial margins and price limits, and these are always moved in line. So that means if there's a 10% initial margin, there's also a 10% price limit. So in a sense, you can avoid sort of cascading intraday failures because the intraday loss can never exceed the quantity that is paid down in initial margin on already, given that China is a pre-trade margin market. If you want to trade, you post your margin, and worst comes to worst, the price moves against you, then you can lose that initial margin, but you can't lose more than the initial margin again, because both the price limit and the initial margin are aligned here. And further to that, the CFMC is actually developing a real-time market supervision system where, again, right now they have sort of day-to-day supervision. With that, they will have real-time capabilities to really track risks in the market in real time. So it is actually a very well-regulated market that has multiple levels of fail-safes. Very briefly, obviously why bans? Well, we do more than just China. We obviously have Chinese market access, but we also have access to all of these international markets. And the good thing is, if you don't want to trade with us, if you actually want to stay with your broker, but you still want Chinese market access, there's actually a solution for that as well, which is what I'll be going into very briefly here. Specifically, as an OSPP, and right now still the only active OSPP, we can actually provide Chinese market access to brokers, which can then provide Chinese market access to their clients. And this is something that, again, was specifically mentioned in the SHFE announcement. OSPP access will be included in the SHFE internationalization. In fact, we are currently already working with the SHFE to submit an application to become an OSPP on the SHFE. And again, this basically means, just like, for example, outside of China, brokers might use other brokers to clear their trades on certain exchanges. we can essentially operate like that on the Chinese market. This means foreign brokers don't need to set up an NRA in China, which can be quite complex based on the conversations we've had with some of them. Instead, for them, everything is happening overseas. It's quicker and easier to operate that than to go through the full sort of onshore OI registration process. And you can also benefit from the OSPP's operational expertise, guidance, and most importantly, English language support. Because again, if you're an OI, you will need to operate in Chinese, in the Chinese market. Whereas through an OSPP, there's no need to do that. And again, we became the first operational OSPP in 2021, and today it's not the only active one in the Chinese market. With that, I've got a few points to conclude here. First of all, the SHFE is opening up entirely, but this is a longer-term process. It won't be complete by tomorrow, but it has now begun. We expect the first contract to be launched will be nickel, and following that, it's probably going to be a few more steps until everything is open, but it will happen, and it should include the entire range of contracts. In addition to that, it's not just the SHFE, it's also the GFEX, DCE, ZC, and CFEX. This is something that is coming from the very top in Beijing. It's essentially their counter towards sort of attempts to isolate China. So really opening up is not just something that the SHFE is doing, it's something that all of China is doing, that Beijing is doing, that the Shanghai municipal government is doing. It is something that really everybody is pushing for. And from a user's perspective, China through the OI route can really be traded like any other market. There are no issues with liquidity, with access or anything like that, fund repatriation. It takes 2 hours to get your money in and out, and there's no restrictions on that. And yeah, with that, I am done with my presentation here for today.